Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Asset-Backed Securities Explained: Types, Benefits, and Risks. Asset-backed securities, ABS, are an important part of today's financial markets. They allow investors to earn returns by pooling various types of loans, such as mortgages or auto loans, into a single investment. This process not only helps lenders manage risk but also provides access to funds for consumers. In this video, we'll break down what ABS are, how they work, and why they matter. You'll learn about the different types of ABS, their benefits, and the risks involved. Whether you're new to investing or just unsure about ABS, this guide is designed to give you a clear understanding. Let's dive in and uncover the essentials of asset-backed securities. Understanding asset-backed securities. Asset-backed securities, ABS, are financial instruments created from a pool of underlying assets. These assets typically include loans like mortgages, car loans, or credit card debt. By bundling these loans together, ABS provide investors with a way to earn returns based on the cash flows generated by the underlying assets. Definition of asset-backed securities. At its core, an asset-backed security is a type of investment that derives its value from a pool of financial assets. These assets serve as collateral, providing security to investors. Common examples of ABS include mortgage-backed securities, MBS, backed by a pool of residential or commercial mortgages. Auto loan ABS, based on car loans taken out by consumers. Credit card ABS, created from the receivables on credit card accounts. These examples show how diverse the sources of asset-backed securities can be, allowing investors to choose based on personal interests and risk tolerance. How ABS work. The creation of asset-backed securities involves several key steps. Let's break down the process. Pooling assets. Lenders combine similar types of loans into a single portfolio. This pooling reduces risk because it diversifies the investment across multiple borrowers. Structuring securities. Financial institutions, typically investment banks, structure the pooled assets into ABS. They assess the risk and potential return of the portfolio to determine how to issue the securities. Issuance of ABS. After structuring, the ABS are sold to investors. These securities entitle holders to receive payments based on the cash flow from the underlying loans. Payments usually reflect monthly principal and interest from the borrowers. Servicing loans. A servicer is often assigned to manage the loans in the pool. This entity collects payments from borrowers and distributes them to ABS investors. Through this process, ABS provide a streamlined method for investors to gain exposure to a range of assets while offering liquidity and flexibility in their investment choices. Have you considered how ABS could fit into your investment strategy? Types of asset-backed securities. Asset-backed securities come in various forms, each with unique features that cater to different financial needs. Understanding these types is crucial for investors looking to diversify their portfolios and tap into specific markets. Here are the primary types of ABS. Mortgage-backed securities, MBS. Mortgage-backed securities are perhaps the most well-known type of asset-backed security. They consist of a bundle of residential or commercial mortgages that are pooled together. Here's how they work. Collateral. Homeowners' mortgage payments serve as the underlying asset, providing a steady cash flow to investors. Tranches. These securities are often divided into tranches or segments that represent different risk levels. Investors can choose based on their risk appetite. Guaranteed payments. Many MBS come with guarantees from government agencies, making them a lower-risk investment option. Investors receive payments based on mortgage payments made by homeowners. If homeowners pay their mortgages on time, MBS can provide a consistent income stream. Auto loan-backed securities. Auto loan-backed securities are created by pooling loans taken out to purchase vehicles. Here are some key points about this type of ABS. Loan source. The underlying assets consist of car loans issued by banks or financial institutions. Monthly payments. Investors receive monthly payments as car owners repay their loans. Risk assessment. These securities typically assess the creditworthiness of borrowers, which can impact returns based on default rates. For investors looking to tap into the auto market, these securities provide a way to invest in consumer behavior while diversifying their portfolios. Credit card receivable-backed securities. Credit card receivable-backed securities are based on outstanding credit card debt. This type of ABS works differently than others. Cash flow from purchases. The securitization comes from the payments consumers make on their credit card balances each month. Diversified risk. Since these securities pool a large number of credit card accounts, the risk is spread out among many borrowers. Variable returns. Payments may fluctuate based on consumer spending and repayment behavior, leading to variable returns for investors. This structure allows investors to benefit from consumer spending trends while balancing risk. Student loan-backed securities. Student loan-backed securities focus specifically on student loans. This sector has become increasingly significant due to the growing demand for higher education. Key elements include loan types. These securities can be backed by federal or private student loans, each with its own risk profile. Repayment options. Many loans come with different repayment plans, influencing cash flow consistency. Market growth. With rising student debt, this market segment presents a unique opportunity for investors interested in education financing. Students' repayments contribute to a reliable payment stream, appealing to socially conscious investors. Other types of ABS. Beyond the common types discussed, there are several less prevalent forms of asset-backed securities, including equipment lease-backed securities. These are based on lease payments for equipment like machinery or technology. Personal loan-backed securities. Derived from unsecured personal loans, they can offer high yields but carry more risk. Small business loan-backed securities. These focus on loans taken out by small businesses, diversifying risk across various sectors. These other ABS types can help round out a diversified investment portfolio, allowing investors to explore niche markets based on their interests and risk preferences. Benefits of asset-backed securities. Investing in asset-backed securities, ABS, offers a range of benefits that can enhance your portfolio. Understanding these advantages can help you see why ABS is a popular choice among investors. Diversification opportunities. One of the main benefits of ABS is their ability to enhance portfolio diversification. By including different types of securities in your investment mix, you can spread risk more effectively. Here's how ABS contribute to diversification. Variety of assets. ABS can include mortgages, car loans, and credit card debt, among others. This variety allows you to invest in multiple sectors. Risk mitigation. Since ABS pool different loans, they can reduce the impact of defaults. If one borrower fails to pay, the others can help stabilize returns. Non-correlation. ABS often react differently to market changes compared to stocks and bonds. This can help balance your overall investment performance. For anyone looking to minimize risk while aiming for stable returns, ABS can be a key component of a well-rounded portfolio. Yield potential. When it comes to yield, ABS often stack up favorably against other fixed-income securities. Investors typically seek higher yields to maximize returns. Here's a breakdown of the yield potential of ABS. Competitive returns. ABS can offer yields that are higher than those of government bonds and traditional fixed-income products, making them attractive for income-seeking investors. Risk-adjusted yield. The yield on ABS reflects their risk level. You might find higher returns on ABS with a higher perceived risk, rewarding you for taking that risk. Cash flow. Payments from underlying assets provide regular cash flow, which can be appealing for investors needing consistent income. For those weighing yield against risk, ABS can serve as a strategic investment choice that aligns with income goals. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.